This question comes from a long-term shareholder who's been here for more than 25 years. His name's Ben Knoll. He's from Minneapolis, Minnesota. And he says, Mr. Munger and Mr. Buffett, after a 15-year period of market underperformance, you're cautious about predicting Berkshire being able to outperform the market in the future. Given this, what do you see as the arguments for longtime shareholders to continue holding their stock versus diversifying their risk across an index?
I recommend it. I recommend the S&P 500 index fund, and that for a long, long time to people. And I've never recommended Berkshire to anybody because I don't want people to buy it because they think I'm tipping them into some side. Never. I mean, no matter what it was selling for. And to stay in Berkshire, I think the odds are Berkshire is, I like it, but I'm not. I do not think the average person can pick stocks. But that I wouldn't argue that the S&P 500 over time. I like Berkshire, but I think that a person who doesn't know anything about stocks at all and doesn't have any special feelings about Berkshire, I think they ought to buy the S&P 500 index.
I don't know about you, but watching that is a little cringy in that Warren Buffett had trouble even recommending his own company and the investments in that company over just the S&P 500. Now, he is a straight shooter with what he invests in and what he recommends. And if you know my portfolio, a good amount of that is inside of index funds that Warren talks about. After he passes, his advice to his trustee is that 90% go in a very low-cost S&P 500 index fund instead of it being all invested to Berkshire Hathaway. And a big reason why he recommends investing in index funds has to do with fees. It has to do with performance. I mean, it's insane to see how much fees can dig into the earnings if you invest in a mutual fund, for example, with just a 2% expense ratio. After 30 years, it could cost you almost 50% of your actual value. It's absolutely insane. So what we're going to talk about in this video are some of the biggest hit index funds. Index funds are different than actively managed funds. These are just measuring or trying to benchmark against an index like the S&P 500 or the US market or international, and we'll talk about all of those. So the index fund is essentially a way that you can invest in tons of stocks at once. It's an investment that tracks a market index made of stocks or bonds, and it's a really easy way to get started and have mass diversification and probably overall have a much higher chance than buying and selling individual stocks. So the main ones we're going to talk about in this video, and we're going to compare the benefits, the disadvantages of each, and historically how they've done. But a big one is the Vanguard S&P 500 ETF VOO. Some of you guys have probably heard of VFIAX. It is essentially the same thing. VOO is the ETF version, the exchange traded fund, which means you can buy and sell it just like a stock. Next, we're going to be talking about VTI. VTI is the total stock market ETF, whereas a VOO was the S&P 500. So VTI is expanding a bit to the total US stock market. And if you've been on YouTube, you've probably heard about VTSAX. Now, VTSAX is the same thing as VTI. It's just VTSAX is not an ETF. And there's a minimum to get started. And in the end, they hold the same thing. They have pretty much the same expense ratio. And the next one we're going to talk about is VT. VT is the total world. So literally take the world's market and you can invest into it just like that by buying VT. Next is VXUS, which is the total international stock market ETF, VXUS. I'm going to be talking about what I do in my own portfolio. I have millions in these ETFs, and I'm going to be sharing what I'm doing moving forward. I'm actually going to make a little bit of a change, and I'm going to explain to you what that is in this video. Let's start off with VOO. Let's ignore VFIAX, and we're also going to ignore VTSAX because those are not the ETF versions. Those make it harder to buy and sell. You have to wait till the end of the trading day to actually execute a trade. And for most people, the ETF solutions are easier. It's transparent pricing. You buy it and sell it like an ETF, but like a stock. So VOO holds the S&P 500. When Warren Buffett is talking about an S&P 500 index fund, and he suggests Vanguard. Vanguard's the company that has these funds we're going to be talking about. He's probably talking about VOO. So VOO is the S&P 500. It holds 509 stocks, the biggest 509 companies. And you can see the holdings are companies you probably all recognize. 27% of the net assets are in these top 10 because it's market cap weighted, which means the bigger the company, the more the fund actually holds of it. And it's all based on the market cap. So we have Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, Berkshire Hathaway, JP Morgan, Johnson & Johnson, Visa, and we have another 500 or so other companies. You can see that the composition is diversified in all sorts of different industries. It's an amazing way to get some of the best companies in the world, has great diversification, and it is a self-cleaning cycle because the S&P 500, things don't just enter it automatically. Once a company becomes profitable enough, has a big enough market cap, and gets voted in, then they are inside the S&P 500 and they'll take the place of another company which will cycle out, which was maybe underperforming. So it's a pretty amazing invention, this S&P 500 idea, as it takes the best companies and it cycles out the low performers. So this is VOO. Next, we're going to talk about VTI, which you might have heard has VTSAX again. Essentially the same thing. VTI is the ETF version. This is the total stock market in the US. So this instead is going to hold 3,755 companies, so around 7 times more companies. And you'll notice that the top 10 holdings are the same. They're the same as the S&P 500. However, they hold a bit less, 22% of the total assets, because there's these other companies that have to do and take up some of that market share. So what does this do? Well, it gives you more diversification. It gives you access to not just the large cap companies in the S&P 500, but also the mid and smaller cap equities, which allow you to have more diversification, and historically the mid and smaller caps have grown more. So VTI is actually around 80% the S&P 500. You can think of it like that because since it's market cap weighted, the S&P 500 represents about 80% of this holding, and the other 20% you can think of as mid cap and smaller cap companies. So VTI invests in around 7 times more companies than the S&P 500. And so you can kind of think of this maybe as VTI has a larger number of holdings. It creates a perhaps more diversified and maybe lower risk fund. The price per earnings ratios are similar. And one thing to kind of keep in mind here is that typically when we think about diversification, right, we're thinking that diversification and safety comes at the expense of lower returns, right? If you think about bonds or gold or diversification, and usually, dang it, I'm going to have lower returns if I'm safer. In this example, that's probably not the case, right? Because this is more diverse by having some smaller and mid-cap stocks, but at the same time, those have performed better over time. So I want to give you some idea. So the VOO and the S&P 500 basically are investing at frothier, bigger prices. So I want to take this example. So Tesla is a good example of this. As you know, we have a good amount of Tesla in the portfolio, and Tesla has had a pretty meteoric rise, right? They've just absolutely crushed it. I think I bought it at $40 per share originally, so we're at well over 1,200%, something like that. So it's had an amazing rise, right? The stock is up 15,000% since its IPO in 2010, and that's a crazy ride, right? It's made Elon one of the richest men alive. It's made so many Teslaonaires, and VTI, which has the total stock market, basically brought on Tesla pretty early. And because it's just tracking, the total stock market, as long as they have over a 15 million market cap, it can be added into this fund. And so the S&P 500, on the other hand, well, that took them a while. The S&P 500 added it in December 21st, I believe, and that already was at a price of $695 per share, is what Tesla was at. That's when these funds, VOO had to buy Tesla. It had to make 1.69% of its entire fund have Tesla in it. So that kind of lost out on the biggest rise of Tesla, right? It's at $695 per share. At filming this, it's under that right now. So VOO did not benefit at all from Tesla, whereas VTI did benefit because they had it pretty early on, not too far after the company's IPO. So they were able, if you invested in VTI, you were able to get the benefit of Tesla really growing. The S&P 500 and VOO, on the other hand, you didn't. So VTI invests in tons of companies that is before their prices skyrocket. So as you think of what's the next Tesla, the next Tesla, if it's a smaller company that you probably haven't heard of yet, VTI probably has it and VOO probably doesn't. So why did I invest in VOO? Some of you guys know that VOO has been my go-to. As you can see here, VOO, 3,950 shares at $380. So a good amount in VOO. Why did I do that? Well, this started around a year ago right in March and April when everything was crashing with the COVID pandemic. And so what I did is I thought, okay, I want to put my money in a place that I feel like is a good place to park cash, which is an index fund. And I put it in VOO because I thought that the bigger companies were safer to weather the storm of the pandemic. So I didn't think that, some smaller and mid-cap companies would weather the storm as well. Some might go bankrupt, as some did. And so that's why I put it in VOO instead of VTI. However, in the long run, I think I'm going to actually move stuff to VTI. This is what I have for my retirement account. So 3,000 shares in that. And if we look at my retirement account, let's go ahead and do that because it's going to bring us to the next fund here that I want to talk about. And here is the retirement account that we have. So right here in this account, we have VTI as our total stock market ETF, VXUS, which is our international stocks, which excludes, that's what the X is for, the US, and then BND is some bonds. So around $1 million in this. And let's talk about VXUS. I got a comment on one of the videos saying, you know what, all you got to do, don't worry about VTI and VOO, just buy VT. Funny story and true. I helped my mom set up her retirement account and I told her about buying VTI, and instead she forgot the I and bought a lot of VT. Since then, it hasn't performed as well as VTI because a lot of the world has not recovered as well, but she put a lot in VT. And here's the thing with VT, it's the total world ETF, which sounds, wow, it's amazing, diversification, great, fantastic, awesome, 9,000 different companies. So wow, that's a lot, right? And as you can see here, it really, the 10 largest companies now are only worth 13% of the total assets. And you'll see here, starting with number 6, we start getting international, the Taiwan Semiconductor Manufacturing and Tencent Holdings. Here's the thing with this. Okay, this is a portfolio composition that you no longer really control. It's just the market cap of the world. So we have North America, Middle East, just 0.2%, Pacific, 12%, Europe, 16%, emerging markets, 11%. Here's the thing with VT. Sure, it gives you full diversification. However, that is good if you only want 60% in American companies. And I actually don't. I want more in the US stock market. I feel just more comfortable with US companies. I still want international diversification. So instead of buying VT, what I instead do is I buy VTI as the US market. I know it says total, but it's just the US market. And then I'm going to buy VXUS for just what I want internationally. So this is just the international companies. So as you can see, remember how we said Taiwan Semiconductor and Tencent were among the top 10 holdings? Well, these are the top 2 holdings in this fund because it's also market cap weighted. And so now I have a diversification of Europe and emerging markets in the Pacific and North America and Middle East, yada, yada, but I can decide how much I want to put. And in my current retirement account, what I do is I have around 80% in terms of the overall stock market composition. We have 80% in VTI, 20% in VXUS. There's some bond allocations here, but if it was just stocks, 80 to 20 US to international. And that is how I've decided to diversify my portfolio, have a pretty strong performance historical kind of guarantee. Nothing's guaranteed, but we obviously have a much safer outlook than just YOLOing on certain stocks that we think we know of, but who really knows what can happen with certain companies, with the founders, with some new lawsuit, so this is a great way to diversify your portfolio and have it in what Warren Buffett might actually recommend even more than his own company and what his own company invests in. So that's it. Thanks so much for watching. Leave me a comment. I'd love to know what you think about your ETFs, if you're going to hold some and which ones that you hold. Please click like if you enjoyed this video. Thanks so much for watching, and I'll talk to you soon.